Hello everybody, welcome to my channel about producing passive income using your uh, investment. So today I'm going to talk to you about gold investment that will pay monthly dividend yields and the yield rate can be over 10%. So without further ado, let's go on to the presentation. So if I look at the chart of gold, in this case I'm looking at the uh, gold ETF GLD, and I'm plotting here a chart with weekly chart from 2011 all the way to like 2022, 2023. So you can see that from this period, like around 2012 all the way to middle of 2020, actually form a very big base. And then after the formation of the base, it start to move upward. And there's usual saying in the technical analyst community saying that the bigger the base and the higher it goes in space. So now, as you can see that right now with the uptrend has been having this bull flat formation and is kind of consolidating and is ready to move up in the next leg of up move. And also another bullish potential for this gold investment is in case if gold GLD in this case goes above this green box that I label here, which is the low of that is the 2011 high. If it goes above that, there's a potential a lot more upward move for gold as well. So let's look at how we can produce dividend yields from GLD ETF. Now the gold asset or gold ETF in this case, normally they don't produce dividends for their investors. So in order to get the dividends, what we can do is that we can use options to create a synthetic monthly dividends. One of the potential use, of course, is use a cover call, meaning that you buy shares of GLD and then sell upside call uh, to get the income. The other way, which is also equivalent method, is from the option standpoint, is you can sell a cash secure short puts, and then you can also get the income from this method as well. So I'm going to share with you these two different methods and how you can get the dividends from this option strategies. So for every covered call is you can sell one call contract for every 100 shares of GLD that you own, right? So for example, in this case, I have GLD at the time of recording is $170.76. If I sell a covered call at 189 strike price with March 17 expiration date, which is will give us about 93 cents of call premium, and the delta for this call is minus 0.17. So it's in other words, it's fairly out of the money. So the delta in this case, which is correlated to the share price of GLD, is pretty small. About 0.17 is almost like based on these two dotted lines, one standard deviation from the existing strike price. And the 0.17 also means that there's about 17% chance, opportunity, or probability that the strike price will go above 189 by the time this option expires. So for the most part, that you can see it's about 83% chance that the GLD price will stay below the strike price by expiration. And so what that really means that the call seller actually can capture the entire premium of 93 cents per share. If you want to capture more dividend yield, another way to do that is to sell, for example, a cover call with a lower strike price, in this case at $186. And so you can see that the delta in this case is a little bit high in terms of magnitude. Is equal to minus 0.24. And so what that really means is the strike price will stay below this, the GLD will stay below this strike price by expiration with 86% and 76% times, and there's about 24% times that the GLD could potentially exceed the 186 call. Also, you can see that from this option trading platform, there's two red bar here. That is the indication of the option calculated the expected move using the implied volatility of GLD. So those are the expected move, and the expected move is that there's the 24% times that probability that the strike price, the GLD price potentially will exceed the strike price. For the 0.17 delta, which is the net delta is plus 0.86. So potentially we can do the same thing using equivalent delta. So in this case, if I do that by using sell put, actually we can achieve the same delta effect. Now let me give you some short introduction. What is a short put is? Short, you can sell one short put for every 100 shares of GLD, and the seller is obligated to buy 100 shares of GLD at strike price on expiration if the share price is above the strike price, which is 184 in this case. And of course, because this is a very deep in the money, and so you collect a fair amount of the premium, which is $6.25, and this short put has a similar delta as the this 0.17 delta cover call. So of course also the $6.25 consists of an intrinsic value because it's in the money, and the in the money intrinsic value is equal to 184 minus the existing price of the GLD, which is 178.76. So in other words, you will get some extra extrinsic value and some intrinsic value. And so if you have a very bullish move, actually potentially the strike price can go above that potentially by expiration. That's one option. The other way that normally you want to get a balance between strike price but also opportunity that it may get exercised is sell at the money put. And so in this case, say for example, we sell at the money, which is $179 put here, and which is about, the delta is about 50%, 0.48 is roughly equal to 0.5. So there's about 50% chance that the GLD will stay below this strike price, and 50% chance that it will go above it. But that's also a good strategy to get into a GLD with a really good price, and so that enables you to also buy low and sell high too, because if the price of the GLD suddenly drops below the strike price by expiration, you can get the GLD shares with your cost base equal to 179 minus $3.10, which means that your cost base is lower by $3.10, and then you can turn around and sell cover call to get it to get a premium. So it's almost equivalent to buy low and sell high strategy. So it works really well also to produce a passive income. So let's look at the synthetic dividend yields, so to see how they compare. So for cover calls for the one that has higher delta, the yield in 46 days is equal to $1.46 that we collect divided by the share price that we collect. and is equal to 0.81%. So the annualized yield is about 6.5%. But if you sell one standard deviation away, which is equal to 0.17 delta, the yield is 46 days. In 46 days is equal to this premium collected by the share price and equal to 0.52%. So the annualized yield in this case is 4.1%, which is lower than 6.5, but also give you a lot more upside growth potential as well in case if gold is really in a strong uptrend. The equivalent short puts that perhaps we can also do is do a 0.47 at the money put, and the yield in 46 days is $3.10 minus the strike price, 179 minus the 3.1 dollars as a cost base, and that give you 1.76% yield in 46 days, and that translates to annualized yield equal to 14%. And so the way to manage these GOD trades is not a whole lot actually. What you do is you can close the trades before expiration date, or you can wait until expiration date. But I think normally it makes sense to close the trades before expiration when the option can be bought back with a small fraction of the premium that you collect, maybe 10%, 20%, and then you can then close the old trades and open the new trades with 30 days to 45 days to expiration. And so this is a continuous trades that you can do with GLD, especially right now is in upward trend, that you can produce income while you still have a lot of growth potential in the underlying gold shares as well. So if you really like this video, I would appreciate that you can click like, subscribe, and also click the bell button, so in case if I have a new video coming out, you will get notified. Again, thank you very much for watching.